YouTube. All right, and guys, so I thought I'd do this quick video on a trade that I took in the Asian session. Now, the basis of the video is just to show you how I read price and, only looking at price and not filling my screen with loads of random indicators. I mean, it looks like my screen's pretty busy, but, this is the screen that I look at all the time. And what I want to demonstrate on this video is just to show you the power of understanding what is going on with price. Don't allow indicators to take you away from the novelty of what's actually happening in price. Now, what you can see in front of you is just the indicators that I use. They're nothing fancy. It's the PVSRA method. So I'll go into explaining more about that whilst we're in the video as well. But I just wanted to do this video just to show you the power of the moving averages. Okay. All right. So I thought I was going to take this trade because, from what you can see here is you've got this big move to the upside by dollar yen. Now, this was the coronavirus vaccine news that came out. There was optimism about it. Now, the market makers use this opportunity to get shorts at a higher price, but also build longs as well for a later date to close them at a higher price. All right. Sounds confusing, I know, but the market makers, we can only judge their behavior on what they do with price at certain levels. All right. So looking at this, I looked at the open for the Asian session. This H here is the Asian session for Hong Kong. And you can see up here, we've got Sydney, Tokyo, and Hong Kong. So it was about 1 o'clock in the morning. Yeah, 10 past 1 in the morning. So I was basing my decision to go short, all right, because as you can see here, price is so far away from the moving average, the 50-day moving average, that is. On the higher time frame, this is 30-minute, and we've also got the 1-minute time frame, but you can see it's very closely knit together here. But the 1-minute time frame is showing a downward trend because the 200-day moving average, which is right here, that's pushing downwards. And you've also got a bit of an the 50 days pointing downwards too as well. Now, the key thing for me is I'm looking for an area where I think the market makers would believe liquidity was at. All right. So looking at the 30-minute time frame, I can see this big candlestick here, right, which didn't finish in green like this one here, but it was just as good as. All right. We've also got the 10500 mark here. Now that is a whole number. That's where the market makers know that there's liquidity there. And that's where a lot of traders may have placed stops from this move to the upside. They may have placed stops here, or they may have placed positions here in anticipation for it to ride back to the upside. Okay. So I was looking for a short. Now you can see these two candlesticks here. I've mentioned this in my last live video trade on dollar yen. Whenever you see climatic volume or these two candlesticks in this formation here, for me it's stopping power. Some people say it's dojis or train tracks, whatever they want to call them. All right. For me, it's stopping power. It means that the price exchanged hands quite frequently in these two areas here and slightly closed above the open and then closed just below it on the other candle as well. So that there was me understanding that the market makers had interests in going for a markdown phase. In other words, they wanted to recover the positions that they obtained from this move to the upside. Now, I didn't think that, look, when you watch the video, before I placed the trade, I was thinking, okay, we will see this area here maybe, but guaranteed maybe we'll see a visit to the 50-day moving average. So the confluences for me were price was below the daily open. Okay, so that's where it's opened at. It was near monthly resistance. It was rejecting price from these two candles here. We're near a whole number, and we are looking at reverting back to the mean. But more importantly, the mean is sitting at a pivot point. All right, so things were stacking up in favor for it to go down. But who am I? You know, it may not go down, but we pay to play. All right, so I'll press play on the video and I'm going to talk through the whole process of what I'm thinking during these trades. Okay, as you can see during that session, I was taking a couple of trades here, and that was a loss, that was a gain, and that was a gain as well. But yeah, I was just taking, and this was a gain as well. Just taking, scalping, taking quick moves, taking the momentum. All right, because all I do is just trade the bounces from the moving averages. That's all it is. That's as simple as this strategy can get. You're trading bounces from the moving averages. All right, but the key thing with this system is understanding when a bounce occurs, what's the likelihood of it continuing in that direction. Right, you can see here that I was just trading a tight range here, and my entries here, I could have got out much sooner, but you know, it was an interesting pre-session to the Asian session, should I say, pre-trading session. But okay, let me just get straight to it then. So this is the 1 minute time frame here, and this is where I base my entries on. Now this is where I am looking to go short, so I'm going to press play. Now we pause the video. Price came up here and rejected the 200-day. Now price is, there's momentum going down, all right? So it rejects the 200-day here on notable volume, because when you see a big candle like that and it fails to close above the 200-day, now remember this is on a 1 minute time frame. When it fails to close above that the 200-day, you usually got a chance to get in to ride the move down. So it could be deemed as a retrace continuation kind of style, all right? Now, when I saw this here, I was like, okay, if we're rejecting the 200-day, at what point would it come back to the 50-day moving average, retest that, and head back to the upside? But the thing is, we had already experienced a massive move to the upside, all right? Some profit taking needed to happen to regulate the market dynamics. Now, the two candlesticks here, if you remember in my last video about the live trade, all right? Oh, sorry, the last video, why prices, when you read price, okay, you get the idea. When I talked about these two candlesticks, they're always giving you a picture of what's to come. All right, so I'm going to press play and we'll see what happens. So I'll move back. Okay, so at this point, when I saw that price had rejected the 50-day right here, all right, that was me ready to take the trade, because although the 105-100 mark was showing support, it had tested it 3 times. Now this candlestick here was, or the concluding candlesticks would determine whether or not the 105-100 mark was going to hold as support. So as we press play, you'll see prices get, so there's my entry, open 3 positions. A red candlestick comes in, so notable volumes come in. If you look on the 30-minute time frame on the right side there, you can see that it's trading below the previous candles here. So we're going to test now the 105-100 mark. So now it starts to stall, because the traders that entered previously at the 105-100 are like, right, okay, our area is being tested here. You know, let's get our money in. Let's see if we can hold it, because we want price to go back up. Remember, the traders who rode the previous move to the upside are hoping that price can stay within that region so they can add more positions and get in for another attempt to the upside. So we got the support there. Now, during this live trade, I was asking myself, could that 105 be support? Now, I've just flipped the time frame as well. Just watch this a second. I flipped the time frame, dropped down to the 15-minute. We are now at the 50-day moving average. So you can see from this confluence of candlesticks here, we've got a lot of support in this area. Now, it's this next candlestick, which is the open of the Hong Kong session, is whether or not this is going to show strength as to whether it's going to hold. So let's go. Drop back to the 5. The 5-minute time frame showing me downside potential. Momentum's pointing downwards. So we got 1, 2, ready. Third attempt here. On the 1-minute time frame, we're testing in the same 3 attempts there. There you go. Notable volume at the lows, rejecting it at the highs. If I jump forward a couple of seconds. There we go. See how price went back to the 105 and it bounced back off it. But you've got to remember, when you're in a downwards trend, 9 times out of 10, the trend is going to be respected. All right. So as much as some traders may have been entering at the 105, 100 mark, all right, still the dominating trend is going to come into play. The skill is to work out when that happens, you know, and that's why it takes so many traders so long to work that out, you know, which is why they're profitable after a certain amount of time. But, you know, when you start seeing this sort of behavior continuously, when you expose yourself to charts, all right, you'll start seeing this sort of behavior and you'll be saying, right, okay, I'm going to put my money on this because I've seen it before. But that's not to say what happens in the past is going to happen in the future, but human behavior doesn't change, all right? Traders will always respond at key levels, as will market makers. So that's one thing I know. You know, I can guarantee to you that market makers will behave exactly the same way at key areas, regardless. You know, they do it in the past and they'll do it again in the future, but we just got to try and capture that moment. All right. Continue on. Just going to skip forward. So look here, you can see how the traders now are stepping in. All right. We've tested the 105, 100 mark again. Now the market makers, they only have interest in sending price lower. And that's evident from the red candlestick here, stopping volume here, and rejecting the 50-day here. So now the market makers are now going to send price lower because the weakness from the retail traders is they're not being able to hold it above the 105, 100. Market makers have an interest. Do you see how price moves quickly in that instance? All right, that's where the liquidity is being absorbed, right? And you know, when you spend enough time at charts, you'll start seeing these things, and then you start to develop a consensus about what momentum, should I say, what pressure is behind price. Is price showing strength to the upside or to the downside? What is price doing that's making you believe that there's pressure to push it down? So here we go. We're now testing the 105, 100. Now it's been broken. Where are the retail traders? Where are the big money banks? Why aren't they stepping in? Because there's not enough strength there. Market makers moving the price just like that. All right. So we've now broken the 105. We're breaking the 50-day on the 15-minute time frame. Now this is where I starting to focus. You see that big red candlestick? Market makers smashed price down. All right. They took in a bag of orders from traders who were there trying to protect the 105, 100 mark. And now the momentum's come in. So we're pushing away from the 50-day moving average, which is this blue area here. Now we're just seeing price now into its own territory. We've got the 15-minute time frame here where price is sitting on the 50-day. I flicked over to gold and then flicked on the higher time frames. Now, just a keynote here. When you see climatic volume like this, all right, notice what I said in the last few videos. Market makers send price higher, all right, in order to open shorts at the highest possible price with anticipation to close them later on at a lower price. And that's just happened here. So coronavirus news, and then the climax came in, didn't close to the upside. The second candle failed to close any further. And then that's when they started. They started offloading the shorts and closing them at lower prices. All right. So we carry on playing the video. We'll look back at this chart in a second. after the trade's done, I think. I think that's what I do. All right, and I'm going to fast forward it slightly. All right, so you can see now, remove him. Okay, so there's another break down to the downside, a big break to the downside there. I flicked across the screens. It's a 5-minute time frame. It's zoomed out. You can see now, right here, I drew this blue zone here because that's where the previous orders, where market makers could potentially send price, but it also sits in line with the 200-day moving average. And you can see price is still pushing to the downside right there. You see the 50-day is edged downwards. We're now heading towards the 200-day. Got the 5-minute there. See the blue box? So this is the area, the profit-taking area for me as such. So you notice I said to you just a few seconds ago, the market makers are recovering positions from the previous move up. They're now closing the shorts on the downside. Okay. So what you notice I'm doing, I'm just flicking in between screens. I only have one screen because that's enough for me. All right. Because then it allows me to focus solely on what's going on. I've got the 105 right here in sight. All right. When you're so close to a whole number, 9 times out of 10, the market's going to try and hit that number because there's liquidity in the area. So when price drops from away from the 50-day, especially on lower time frames, expect it to retrace back. And usually with the retrace comes the continuation to the downside. But because there was so much momentum in this move, all right, it just kept on going down. Because the strength was there, the momentum was there, the market makers wanted price to go lower because they exhausted the move previously to the upside. Now they wanted to start taking profits. I'm just fast forwarding it. See how price is just dropping now. Keeps on going. See, we touched the 105 and then bounced away from it. And then the market, see, now we're in on the hourly time frame. You can see now we're in the blue profit taking zone. Just keep flicking in between time frames, and we've broken the 105. Usually a bit of momentum comes in once you clean a whole number. So we're going to be looking, and there's that momentum right there. Keeps on going, it keeps dropping. Keeps on going. I actually deleted a couple of indicators just so it's clearer for you guys. We keep going. Now, because we are now due to have a new candlestick in 2 minutes time, which is a new 30-minute candlestick, usually we're going to see price retrace back. All right. And I didn't want to leave any money on the table. So I'll just skip forward. And from this candlestick here, I realized that the move to the downside potentially stopped for a moment, but I wanted to just close the profit, get the profit locked in. And I'll do that right here. Maybe wait until the candle opens exclusively. I think that's what I did. Trying to scalp the last bit. You know, this is me being greedy now. See how price is stalling now. What happened to the momentum just a moment ago? Where's the momentum? Still not doing anything. There's a nice long pause there, right? And that was the signal to me there that I needed to get out of this trade. Let's see in a second. One more minute for the, well, 1 more minute. I was wrong, sorry. I didn't get out of the trade just then. There you go. There's the open of the new candlestick. And I straight away close the trades. Supposedly close the trades. Come on. There we go. All right then, so going to explain quickly how we can use the 50-day moving average. All right. So when you're considering the direction of a trend, always ask yourself, right, where is price in relation to the moving averages? So if price is below the moving average, you're going to enter for short. And if it's above, you enter long. That's point 1. Point 2, when price is deviating away from the moving average, that effectively is where the momentum is going to start coming in. All right. Now, if anyone understands the concept of mean reversion, it's a theory that says that when something moves away from its average, most of the time it's going to return back to it at some point. And the same is applicable in trading. All right. So whenever you see price deviating away from a moving average, all right, anticipate that it's going to return, which you can use as a form of an entry as well. All right. So for example, if you look here at the bottom of this trade here, where price stalled, it actually returned back to the 50-day. So even with this simple strategy, so wait for price to pull away from the moving average and then wait for it to return. When it returns to the moving average, you effectively could do a retrace continuation trend. All right, because you can see it's happened. This is exactly where I opened the trade. I waited for it. In the first trade, I took it and it traded away from the 50-day, and then it bottomed, and then it retraced back to the 50-day, and then I used that opportunity to re-enter, and then it's continued to the downside. All right. Now, when you're considering what candlesticks to use, frankly, I don't really look at candlesticks. I'm looking at momentum. All right. So momentum has to come into play. Now, it's a bit difficult me expecting you to, understand how momentum works, but what you're looking for is you're looking for a confirmation candle, and it's usually a long candlestick where it's obvious that price is rejecting and pulling away from the moving average. All right. And anyone that's new to trading, when you get these indicators, you'll understand that whenever you see price pulling away from the moving average, usually it's going to come with a red candlestick, one similar to this here. All right. And frankly, guys, that's all you need to know. There's no point if you can't explain something in a few sentences, then you don't really know it thoroughly. And Einstein said that. Now, I'm not saying I'm Einstein, but what I'm trying to get at is you don't need to know anything else. Wait for price to pull away from the 50-day. When it does pull away from it, expect it to return back to it. Once it returns back to it, watch what it does from there. If it's going to continue in the trend that it preceded, then ride that trend. If not, and it goes goes above it, then wait for it to pull away from it. And then when it retraces back, make your entry and wait for the continuation. That's the best way to explain a simple, 50-day moving average strategy.